In the race to dominate the electric vehicle market, profitability remains a steep uphill battle for many manufacturers. With Tesla's aggressive price cuts pressuring competitors, the question isn't just who will sell the most EVs, but who can do so profitably. Now that the supply chain is evolving, other auto manufacturers will reach profitability if they scale, though many manufacturers are pulling back from the market because the already profitable market leaders are cutting prices aggressively. In this video, we'll look into the evolving dynamics of the EV market, examining why many manufacturers are struggling to scale their operations, what this means for electric vehicle prices, and how it will impact the future of the automotive industry. Over recent years, electric vehicles, EVs, have steadily gained market share from internal combustion engine, ICE, vehicles, reflecting a significant shift in the global vehicle market. In 2018, EV sales saw a modest 2% increase, while ICE vehicles experienced a slight decline of 2%. By 2020, this gap had widened substantially, with EV sales increasing by 33% even as ICE vehicle sales fell by 15%. The most dramatic change occurred in 2021, with EV sales soaring by an impressive 113%, emphasizing the growing consumer and market preference for sustainable transportation. This trend continued in 2022, where EV sales rose by 59%, while ICE vehicle sales saw another decline of 4%. Looking ahead to 2023, projections indicate that EV sales will continue to outpace ICE vehicles, with an expected growth of 28% compared to a modest 9% increase for ICE vehicles. As electric vehicle EV adoption continues to gain momentum, the auto industry is likely to undergo significant consolidation and restructuring. Traditional automakers are already feeling the pressure, as evidenced by recent announcements from major players. General Motors has delayed EV truck production at its Michigan plant by a year, highlighting potential adjustments in response to shifting market dynamics. Similarly, Volkswagen Group has postponed the establishment of an EV battery plant in Europe, citing sluggish demand and a lack of business rationale for further expansion at this time, according to CEO Oliver Bloom. Ford is also reacting to the evolving landscape by cutting weekly production of its F-150 Lightning due to slowing demand. These developments come against a backdrop of rapidly increasing global battery electric vehicle (BEV) sales market share, which has grown from less than 1% in 2013 to a projected 15% in 2023. This dramatic rise underscores the accelerating consumer preference for EVs and the mounting competitive pressures on traditional automakers. If EV adoption continues to gain traction, traditional automakers may be forced to restructure and consolidate. Wright's law, which predicts that for every cumulative doubling of kilowatt-hour produced, battery costs will fall by 28%, has proven to be an accurate model for the decline in battery costs. The chart shows that as cumulative kilowatt-hour production increases, the cost of nickel cells and lithium iron phosphate (LFP) cells consistently declines. This trend highlights the competitive edge gained through economies of scale in battery production. LFP cells, known for their cost-effectiveness and safety, have seen their market share in passenger EVs rise dramatically from just 3% in 2019 to an anticipated 40% in 2023. The continued decline in battery costs, as modeled by Wright's law, is a critical factor driving the expansion and affordability of electric vehicles globally. Wright's law also indicates advancements in EV charging rates, reflecting improvements in efficiency, range, and power. Over the past 5 years, the time required to charge an EV for 200 miles of range has significantly decreased from 40 minutes in 2018 to 15 minutes in 2022. This trend is set to continue, with projections estimating a further reduction to 12 minutes by 2023 and 4 minutes by 2027. Faster charging rates make electric vehicles more convenient and appealing to consumers, addressing one of the major barriers to widespread adoption. As charging times decrease, EV manufacturers are likely to focus on optimizing other vehicle features such as autonomous driving, safety, and entertainment systems. Electric vehicles, EVs, have achieved price parity with internal combustion engine, ICE, vehicles, marking a significant milestone in the automotive industry. As battery costs continue to decline, EV prices are expected to decrease further, potentially driving exponential growth in unit sales. The U.S. new vehicle transaction price trends show that, before the recent supply chain bottlenecks, the average transaction price of new vehicles, including EVs, has been on a steady rise. However, EVs like the Tesla Model 3 and Model Y are now priced competitively with traditional compact and luxury cars, aligning closely with the overall market. As EV prices become more affordable, the addressable market expands significantly, indicating a broader consumer base willing to consider EVs over ICE vehicles. If EVs continue to gain share, as we believe they will, then used cars and new EVs will make more economic sense than new internal combustion engine vehicles, perhaps causing a death spiral for incumbent auto manufacturers. As EV and used car prices fall, consumers could delay purchases, waiting for even lower price points.